All right, today we're going to talk about a concept that honestly can make or break your success as a manager. It's called accrual accounting. And I know that sounds like something just for the finance department, but trust me, it's the absolute core of how to really measure how well your team is doing. So let's just dive right in with a pretty tough question. If you're only looking at the cash that comes in and the cash that goes out every month, well, there's a good chance your profit and loss statement, your P&L, isn't just a little bit off. It might be giving you a completely false picture of your team's real performance.
So what's the problem? Well, the villain of our story is something called the accrual gap. It's that totally normal, unavoidable time lag between when you actually do the work and when the cash finally shows up, or when you use a service and when you finally pay the bill. That gap, it can make a fantastic month look just okay, or a really tough month look surprisingly good, all because of timing.
So how do we fight back? Well, the solution is a pretty major shift in how you think. We've got to move away from just chasing cash and start looking at the true economic reality of the business. That's what accrual accounting is all about. It's recognizing value the moment it's created or used up, not just when an invoice finally gets paid.
Okay, so how do we actually bridge this gap in practice? It's way simpler than you might think. We've got a toolkit with 4 key adjustments, and believe it or not, they all come down to answering one really simple question. Which happened first, the business activity or the cash changing hands?
And check this out. This table basically lays out the entire playbook. It's all about timing. See? If the actual economic event, like you delivering a service, happens before you see the cash, that's an accrual. But if the cash moves before the service is delivered, we call that a deferral. That's it. That's the whole framework. So let's dig into accruals first. This is the world of event happens before cash. An accrued expense is when you've already received the value, like your employee's working all month, but you haven't paid them yet. And on the other side of that coin is accrued revenue. That's when you've done the work, you've delivered the value, but your client hasn't paid you yet. In both cases, the actual economic event has already taken place. And this is the perfect way to think about it, right? You're using electricity every single day in December. You are creating that economic expense constantly. But the cash itself, that doesn't leave your bank account until sometime in January. Accrual accounting is what makes sure that December's P&L actually shows the cost of the power you used in December. All right, now for the other side of the matrix, deferrals. This is when the cash moves first. A deferred expense is something like paying for your company's insurance for the whole year up front. That payment sits on your books as an asset, and you only expense it month by month as you use up the coverage. And then there's deferred revenue. So many businesses run on this. When a customer prepays for a 12-month software subscription, you can't count that as a win just yet. That cash is a liability. It's a promise to deliver a service. You only truly earn it 1 month at a time. Okay, now we're getting to the single most important rule that holds this entire system together. It's called the matching principle. And honestly, if you get this, you get the key to making your P&L a truly reliable tool. The matching principle sounds technical, but the idea is actually really simple and powerful. You have to record your expenses in the exact same period as the revenues they helped you create. So if you run a big marketing campaign in June that drives a bunch of sales in June, the cost of that campaign and the revenue from those sales both have to land in June's P&L. It's the only way you'll ever get a true picture of your return on investment. Let's look at this classic example of what happens when you get this wrong. So your team completely crushes it in quarter 3 and earns a big bonus. But the cash for that bonus isn't actually paid out until quarter 4. What happens? Well, Q3 looks artificially amazing and Q4 looks inefficient. The whole picture is warped. The right way to do it is to accrue or record a third of that bonus cost each month during Q3. That way the cost is perfectly matched to the performance that earned it. So you can see, understanding this stuff isn't just some boring academic exercise. Getting it wrong leads to really serious and, frankly, very common mistakes out in the real world. These are probably the 3 biggest traps that managers fall into. And you know what they all have in common? A simple breakdown in communication between the people doing the work and the finance team. If you don't tell finance about a service you've used but haven't been billed for yet, your costs are too low. If you treat a customer's upfront deposit like a finished sale, your revenue is too high. Either way, you're flying blind. And I really want to double down on that second mistake because it's a huge one. When a customer pays you upfront, that cash is not a win. It's a promise. It is a liability on your books because you still owe that customer a service or a product. Counting that cash as revenue before you've delivered is one of the biggest ways to create a totally false sense of success.
And look, the fallout from these mistakes goes way beyond just a messy P&L report. It messes up everything. It makes it impossible to forecast accurately. It distorts how you allocate resources. Your budget decisions become reactive, just putting out fires, instead of being strategic. And maybe, worst of all, it really damages the trust between you, your bosses, and your finance partners.
Which brings us to this final thought. When you really master these concepts, you literally transform your P&L. It stops being a distorted mirror reflecting the weird timing of cash flow, and it becomes a true compass that points you toward your actual performance. So the real question you have to ask yourself isn't just about the numbers. It's about whether you have the clarity you need to actually lead your team effectively.